Hello, this is Brad Harvey. Welcome to our Ask the Advisor video series, where we answer your financial questions. Hello, this is Brad Harvey. In today's Ask the Advisor series, we're going to answer the question of whether or not cheap companies are good companies. In today's market volatility, we're seeing an awful lot of companies that look as if they're on sale. Their price has gone down dramatically. And in value investing, you're trying to buy fallen angels, as they are referred to. What that means is good companies that are on the cheap. But just because a company's gone down in value does not mean that it's a good buy. Obviously, we want its values to recover, so we have to look behind why has the price gone down. If the price has gone down just because of indiscriminate selling, and all other things are being equal and their earnings are fine, then absolutely, we want to be owning those companies and we'd love to own them cheaper. However, if there is a bigger problem going on, just because they're cheaper doesn't mean that they're a good company. For example, Radio Shack Corporation. Haven't heard about Radio Shack in a long time. Well, they were a good company for a long time. All of a sudden, their stock price started selling off, and selling off rather dramatically. Turns out they went out of business. So just because they were cheap doesn't mean they were a good company. It's very important to keep in mind there is a difference between a good stock and a good company. However, there are certain value companies out there that might have sold off because of short-term news cycles or other things, or short-term changes in earnings due to restructuring or things like that, where we want to pick those up. They're good values. But again, just because they're cheap doesn't mean they're a good value. Right now, cruise lines have gone down a ton in terms of value. Are these good companies? Probably. Are they all going to survive this recession and the coronavirus? We're not sure yet. So it's a little early for us to try to be picking those up en masse. So we want to be very, very careful. Do your homework. Obviously, the companies that we want to own, we're buying companies that are making money. We're paying for those earnings. And if their earnings are staying pretty stable and the stock price goes down, then we want to pick them up. They're value buys. And typically those companies pay dividends. We like dividends. So it's very important to take a look at the fundamentals. How are those companies doing financially? Is there another reason why they're selling off? Is it short term? Apple Computer sold off when Steve Jobs passed away, but they came back. Why? Because their earnings were solid. So this is Brad Harvey with Ask an Advisor on should you buy companies just because they're cheaper? Thank you. Thanks for visiting our channel. We hope you found the information valuable. If you want to see more videos about investing, please click to subscribe. If you have any questions you'd like for us to answer, send us an email at him@riagroups.com. We would love your feedback.